Good afternoon, everyone. As we get started, I'm waiting for participants to join. So I see people coming in, and I'll just kind of keep going while people pop in. Today, we get to talk about the really fun stuff with taxes. So we're going to talk about the one big, beautiful bill. With that, I'm going to remind everyone that in general, everything we talk about is not meant to be specific to your situation. So please make sure you do come and see us or talk to your advisor if you decide you want to do something before going out and doing it, because I'm going to talk about some things today that are pretty specific, and I want to make sure people get them done correctly if they do follow any of the ideas. As a start, for those of you that don't know me, my name is Jon Meyer. I run the wealth management side of the house here at BGM. And from that perspective, BGM is made up of many different companies with different opportunities. So if you have any of these needs right here on the left-hand side, please reach out at any point and take a look at our website, BGM 360. With that, I'm going to jump into today's agenda. I've got some stuff to talk about that's related to what provisions in the One Big Beautiful Bill were made permanent or even extended from where they were at. So some things are the way they are. I'm going to talk about some things that are temporary, and then a couple of things that are just notable because they do something new. As we get going, I want to remind everyone that the Q&A box on your ribbon is available if you want to ask questions along the way, so please do. I'll be happy to try to answer them. If they're too specific to your situation, I might have to defer, but I certainly will try. And if you have any desire to talk after the fact with anything personal, you're welcome to just reach out to me by email, and I'll have that at the end of this. So with that, let's get going. We're going to start with provisions that were made permanent or even extended. The way I lay this out is I'm going to just talk about the opportunity that it gave us, and then what are some planning ideas to go along with that. And basically, when we start out with what was extended, it kind of is almost a boring topic in the sense that we already know this to be the law. And so since we didn't go back to the old law, it is what it is. But if you think back to 2016, a lot of what changed under the tax bill of 2016 had a 10-year run to it. After 10 years, it was going to go back to the old way. So what this One Big Beautiful Bill did is it actually made that stuff permanent moving forward. And in this scenario, one of the big things is it made tax brackets permanent. If you remember, prior to 2016, tax brackets in general were about 3 percentage points higher than in many of the brackets. And so today they're now made permanent at the what we've been known to use for almost the last decade anyways. The opportunity here, and I'm going to jump to the next slide in a second, is charitable bunching in single years, Roth conversions in lower income years, and timing of income in certain years. These things are that much more useful since we know what the rules are of the game. And so what I've done here is just laid out the different tax bracket opportunities. I think what people kind of forget, and this gets into a bigger issue, is when we save money, saving's easy, it's distribution of money that gets tough. In looking at the distribution side, though, what we want to focus in on are what brackets do we fall into? For example, married filing joint. If you're in the 12% bracket, you're earning $96,950 or less. Now, when I say that, you may be earning more than that. It's taxable income that matters. And taxable income is your adjusted gross income minus any deductions. So when we look at this, this is where we focus in on to see what bracket you're actually in. And when I referred earlier to the idea of bunching deductions, sometimes it makes sense to do things like take charitable deductions in certain years to try to get under these limits. But it also could make sense if you're underneath the limit by a bunch. Let's say let's say you're $20,000 below this 96, so you're at 76,000. It might make sense to add $20,000 more income, whether it be taking it out of an IRA through a Roth conversion, or if you can time some kind of stock options or whatever, to get it up to this limit because you're getting it at this cheaper rate. If you took it out somewhere in the future, maybe you jump up to this new bracket and then have to pay a higher rate. So this is where we get into this whole idea of tax arbitrage and how do we make sure that we can control within the limits we're at. And I point out the 12% bracket, but for people in 22 trying to avoid up to 24, people in 24 try to avoid going to 32. These are the kinds of things that now that this is permanent, we can focus in on that much more. We've been looking at it from the angle of, well, this is going to expire, and so we need to act as fast as we can. But the reality now is we have a little bit more time. So just as you get started in thinking about this is where your head should go on almost everything you do. And this is where we focus our attention when we look at someone's tax return. The next thing that was made permanent is mortgage interest. For a lot of people, this may not matter, but if you do have any kind of child or grandchild you're helping, maybe they have this issue. So I just want to make it a note of it. And what's interesting in this is starting in 2026, private mortgage insurance, or what we know as PMI, becomes deductible. So if you can deduct, if you're itemizing, you could deduct the PMI side of things. I bring it up because that's not been that's a new thing. That's not something that's been in the law. So keep that in mind. If you do, most likely on this call, most people have their homes paid off, but if you have a child or grandchild, that could come into play. All right. Next up, the permanent deduction. Standard deductions have been made permanent. So when we look at 2025 amounts, these are the standard deductions moving forward. Everything stays basically what it was. What's interesting in here, and I'm going to point out probably three specific things within the One Big Beautiful Bill that are unique, maybe even troubling, if I could use a word, that I want to point out, because out of all of my slides, there's a couple of things that are big, and this is a big one. Basically, one thing to consider is that if you're going to give to charity, if you're going to give a large amount to charity, do it in 2025. Because starting in 2026, what happens is there's basically a new rule around itemization. With charitable giving specifically, you don't even have to itemize. You can just take the standard deduction. If you qualify, you can deduct up to $1,000, or if you're married filing joint, $2,000 for charitable giving. That's not that big a deal. The big deal is the second point. If you're itemizing, basically starting in 2026, there's a new 0.5% floor on adjusted gross income. So what that means is when you itemize, the first 0.5% is basically ignored of your adjusted gross income. So think of this as, maybe it's not a big deal, but think of it as if you're making $200,000, the first $1,000 of deductions are ignored. The second part to this, though, and this is the bigger issue, is that there's a new cap on the value of itemized deductions. And when I say itemized deductions, really I'm thinking about charitable contributions, because this is the thing that moves the needle. This new cap basically says that we're not going to let you deduct, even if you're in a tax bracket higher than 35%, we're basically going to only let you make deductions in the 35% tax bracket. Now, this may not feel like very much. Let's go back. I'm just going to go back a couple slides to this one. If you think about that, here's the number we're talking about if you're married filing jointly. So that's the 35. And if you have more than that number, now you're in the 37. So for a lot of people, this might not apply. But it could apply if you have years where you have some weird thing come into play from some big income opportunity. And I bring it up because, in essence, everyone says, well, who cares? We're going back 2%. So let's pretend I made a $200,000 contribution to a charity, and I can't deduct it at 37%. At 35%, I lose 2%. 2% on 200,000 is $4,000. Not a big deal. But that's not the math. The math is actually 2/37ths of $200,000. And when you take 2/37ths of 200,000, you're actually losing out on somewhere between $10,000 and $11,000 worth of deduction. So instead of it being 4 grand, which is kind of where our minds jump, that's not the math. And so you got to look at how this actually impacts you. And I bring it up because for people that are going to make large contributions on big income years, especially to charity, I think the biggest opportunity in 2025 is to think about it from the perspective of how many years do I want to fund? Let's say I want to give to charity 5 years worth of contributions instead of just the next year. So what I do is I take 5 years worth, add them up, and make a contribution to my donor advised fund this year to get the full deduction so that next year I don't have this issue. This is where donor advised funds could come in really handy, quite honestly. So I bring it up because of this new rule that's coming into play. Maybe it's not a big deal for some people, but I've already run into a few scenarios where this is going to have a pretty big impact on some people. So I would like to call this out. And there's about 2 other really big ideas in here that I'll call out, but that's one of them. So please, please, please think about this idea of charitable bunching. Next up on the permanently changed slides is the estate and gift tax exemption. Starting in 2026, the estate gift tax is made permanent at 15 million. Right now it's at closer to 14 million. That jumps to 15 million. And then it's indexed for inflation and it's made permanent. If you remember, the law had this expiring at the end of 2025, and we would have gone back to a really low number, but now it's set at these higher numbers. So this is important because you do have the ability, if you think about this, to use a bigger exemption of this 15 million. If you're married, joint couple, you could have 30 million then. So this is an opportunity from a gifting perspective. And what I want to point out too is it's a state and gift tax exemption, meaning you can use it while alive or dead. And not enough people know that. So from the standpoint of gifting, you could gift to your kids or your grandkids while living today a decent chunk of money. And you could do it through trust. You don't have to give it to them directly, but you get it out of your estate so it keeps growing at some pretty high levels. So I'll bring that up because that is a really good opportunity for a lot of people. And the other thing though is, and I'll point this out, is when you do give money, you do lose this step up idea. Because you're gifting your cost basis. And so you lose the idea that at death, you get a step up in that cost basis. So you're giving away, in essence, someone else is going to pay the capital gains tax when they use the money. So that's a big deal for us because it does lock in some estate planning opportunities. I'm going to skip through the next few pretty quick because I suspect, just looking at the list, we don't have a ton of business owners on this call. But if you do know business owners, there are some things that have been made permanent, like this QBI deduction, where you can deduct up to 20% of certain pass-through income. This idea of qualified opportunity zones has been made permanent. So for people that want to invest in these kinds of tax advantaged ways of doing things where you can get some step up in basis and save yourself a little bit of money, there could be some opportunities here. And then third, the lock-in on 100% bonus depreciation is a big deal for some capital intensive businesses. So I do want to point these things out, but I'm not going to spend a ton of time on it. One thing to point out from a personal standpoint is that going back to 2016, we used to have personal exemptions. Those are still eliminated and not in this plan at all. So there are no such thing as personal exemptions yet. And then there was an argument, they were trying to look at adding miscellaneous itemized deductions. Again, we used to have that in 2016, like unreimbursed work expenses. Those are also still eliminated. So keep that in mind. It doesn't affect most people. Most people probably don't even think about this stuff, but I just want to point that out. All right, now let's jump to the temporary provisions. These are the things that are going to change for a period of time, and it could be that they only are in place for the next couple of years. So there's a couple of them that are kind of interesting. The first one is basically the SALT deduction. So if you remember back before 2016, we used to be able to deduct all of our real estate taxes, state income taxes, things like that. And then as of 2016, that changed and it now got limited to $10,000. Well, that is changing. So basically, what's going to happen is the SALT deduction is going to increase for the next 4 years and allow us to go up to this $40,000 number instead of 10,000. There is a phase out that begins around 500,000. So for people that are very high income, they're going to lose some of this. But in essence, the $40,000 number is going to be the new number for the next 4 years. So it is kind of interesting that this is in place. Plan accordingly, especially if you have years where you think you're going to take a lot of income for whatever reason and affect these $500,000 income limits. So that would be one thing. The second thing that it did keep in place, and I want to just point this out, is again, if you're a business owner, this pass-through entity tax election, that's a really big deal. They were trying to get rid of it, but that stayed in place. And so if you're a business owner, I still run across business owners that don't elect this, and it's kind of interesting to me. In essence, what it does is it allows the business to pay your state tax and then make that deductible from your federal tax. It's a workaround for these other issues. So I just point that one out quick. Outside of that, the other thing that's new is for people age 65 and older, you get a new deduction. So basically, every taxpayer over 65 gets this new $6,000 deduction. That is new, and that's only for a few years, so keep that in mind. But whether you itemize or not, you're going to get this. It's kind of a new thing to just keep track of. Again, there are deduction phase out limits for incomes. These income limits are probably a little low for many people. And so you have to look at this and see if you might even get it, because not everyone may get it. But I point that out because I already have heard of people saying, oh yeah, I get this for sure. And the answer is maybe not. And the reason I bring that up is because if I go over to the right-hand box here, you're going to want to really pay attention to withdrawals from IRAs, conversions out of IRAs. Maybe if you're over 70 and a half and you can use qualified charitable distributions as a way to get rid of some of your IRA money instead of having to hit your tax return. Those are the kinds of things that can affect these limits and therefore might help you qualify for a little bit. So I just point that out because these things come into play on the distribution side. This probably affects your grandchildren more than you, but just as a reminder, there is a new, if you remember, no tax on tips was the big thing this year. And basically the way that was written into the law is for people making less than these dollar amounts, there's a new no tax on the first $25,000 of qualified tips. We all think of that as people working in restaurants. There could be other industries that affects, but in essence, that's what we want to focus in on for people that have qualified tips. For people that aren't necessarily just dealing with your grandkids' issues, though, there's also a new qualification for no tax on overtime. And so there is an ability to, if married, up to $25,000 of avoiding certain taxes on that. And these are the income limits there. So keep in mind there is a deduction phase out after these limits of these numbers. But again, it would matter to pay attention to this if you're close. A fun new addition because of the focus on bringing production back to the United States is the idea of adding, making car loan interest deductible. So for the next few years, there is the ability to deduct up to $10,000 of interest on a new vehicle. If you go to a car dealership, you will see a sticker on their window, most likely, that says whether this kind of car qualifies or not. It's going to be, because what in essence has to happen is the car has to be, um, built in the USA. Majority of the um, production has to be in the USA. So it can be used, they can use parts outside of the US, but they have to build it here. So just as a aside, that is something new. In many cases, I gotta be honest with you, it may not be worthwhile to do something like this, because right now with interest rates higher, the cost of borrowing may not be worth it. But again, if it's for kids or grandkids, I just bring this up because you never know if that comes into play. But just keep in mind, there are some deduction limits for higher incomes. All right. I am nearing the end of the easy part. So for those of you that do have questions, I'm just going to remind you, bring up questions. Other notable provisions. Here's where we get into a couple of other ideas. So I mentioned that there's three things in my slide deck that I really probably wanted to focus in on. One was the charitable deduction limits on both the low and the high side. The second one are these new Trump accounts. The Trump accounts are interesting because basically what it's doing is it's taking the ability to contribute to an IRA, which most of us have, and giving it to kids under the age of 18. And what's interesting about this is there's no income limits on this. Typically with an IRA or a Roth IRA, there has to be earned income to contribute. But in these scenarios, there doesn't have to be earned income. Secondly, you can contribute to this for your child or grandchild. There's no rules around that. The issue is that you're using after-tax money. So the 5,000, let's say, that you would put in is going to be after tax. The earnings on the 5,000 would be taxable when you pull it out at retirement. So that's where the issue is that you do have the earnings that will be taxable, whereas the money going in is after tax. So there's an accounting thing here that we need to track. Now, I don't have every let's put it this way, the rules are not completely written yet. The framework of the law is there, but the rules are not written, which is why I add this little notation down here. But as you think about that, let's pretend that that's true. The idea may come down the road where we could do something where we do a Roth conversion once they're 18 years old and in a low tax bracket to clear out all that taxable growth and move forward. So we'll see. But I want to see what the rules are. The other thing to point out in all this is these accounts don't start until 1 year after the law was put in place. So that would be July of 2026. Kind of a weird start date, but we are waiting to see the rules, and then next July we can actually start doing these things. Second part to this that's interesting is the government can contribute the first 1,000 if you have a child born in these years. Again, we don't know the rules. It's kind of interesting that they would say 25 is a year that if your child's born, you get this extra $1,000, because technically we don't get to open the accounts until July of 26. So we're waiting to see what that means. But I bring these up because we're always looking for ways to move assets to the next generation. And this could be an interesting way to do something that's built more for the long term, where you give kids and maybe your grandkids a real head start for something way down the road, as opposed to something that they could spend when they're 18. That's why people don't always like UTMA accounts, which is the Unified Transfer to Minors Act. Some people don't love 529 plans. for that reason, because it could get spent before that. But these things could go on for multiple decades and really grow into a big dollar amount. And one of the questions that just popped up is, just to be clear, Trump accounts are eligibilities for children or grandchildren under 18. And the answer is yes. It's any child under the age of 18 qualifies for these. So again, July of 26 is the answer though. So from that standpoint, I really like these as another method to transfer assets. The second interesting thing that popped up, or now the third. So I said three things. Second one was the Trump account. The third one is this 529 plan change. So for years, we've been putting money in 529s and waiting till college to get it out. And then a couple years back, there was a rule change that said within the law, and it's more than a couple years, is a few tax bills ago, that you could now spend up to $10,000 on K-12 private education. So what really it comes down to for a lot of people is, oh, I want to send my child to a private high school, and I don't have enough money, but my 529's got a lot in it because my mom and dad have been contributing. So now the 10,000 is going to be doubled starting in 2026 to 20,000. All of a sudden, this is interesting because now this 20,000 is enough for a lot of private high schools tuition. You're going to cover quite a bit. The second thing that was done is they expanded the list of eligible expenses within that 20,000. And so there's a few more opportunities for things that you could pull out. I would note, for example, testing fees, textbooks, things that sometimes people are like, ew, these are extras. So I point this out now because 529 plan for a lot of people has been a interesting opportunity for college. But if you at all want to fund even below college for private schools, this could be an interesting opportunity. That's the third probably big takeaway from today, particularly for grandparents on this call that are trying to help their grandkids. With that, couple slides left. For those of you that are doing this, I don't know if anyone's doing this. I've had one call recently on this, but there's some clean energy credits phasing out at the end of the year. So if you're at all looking at electric vehicles or typically panels on the top of your house, I would say be quick about it, because for the most part, these things are ending. And if you want to do something, you're going to have to get it in place quickly, because if not in place, especially solar panels, if they're not actually on the house by this time frame, it doesn't count. So I want to make sure that people know that if you're at all contemplating it. So today, as I wrap up, what I was trying to do, and in short form, I didn't want to make this really too long of a webinar. I wanted to make sure everyone just understood that there are some opportunities based on how the law was written to figure out specific years where you should take itemized deductions versus standard deductions. And when I take the itemized side, I really, really, really want you to focus on charitable giving in 2025 as a key issue versus 2026, if you're at all going to give away a large amount, because I think that's where some of the opportunity lies. At age 65, for those of you there, make sure you look at the income limits. If there's a senior deduction to be had, we should understand that. Third, for people that probably have kids or grandkids in this issue, look at the overtime issues and the no tax on tips. Fourth, the biggest thing here is with these new deductions where we get 40,000 instead of 10,000 on our SALT deduction, where we can maybe get some deductibility on PMI if needed. These are some interesting opportunities. So again, this might clear the way for other things. Like, for example, with this higher SALT deduction, doesn't mean I could do a larger Roth conversion to offset some of that SALT deduction and keep that Roth conversion at a cheaper level. Might make sense. Fifth, look at these Trump accounts and look at the new 529 rules. And then 6 for business owners. Here's some stuff to consider. I'm going to do something here and see if I can do this. So I'm not making this work. Just going to try to do something for everyone. So I have a PDF of a summary of the big beautiful bill that we built. So it's a 2-page summary. And I was trying to drop it in the chat, but it's not working right now. So I guess I won't do that. But what I will do is I'll attach it to the recording. So when you get the email after this that says, here's the recording, make sure you log in and grab the PDF as well. The PDF is interesting. It's it's about a 2-page PDF of a detail of all of these different provisions, and even I think there's some things on there that I didn't talk about today. So keep that in mind. Before we close, we've got a couple more questions because it is time to close it down. So, oh, there's the PDF. I wanted to bring it up. This is what you'd be seeing if you log in and grab it. It's a nice summary of everything that I talked about, and that would maybe help you understand what's going on a little bit more. Of course, you can always reach out to me too, and that's what I was trying to bring up here. If you want to reach out to me, I'd be happy to also send you the PDF with anything you need. So let's answer these questions. So does the 35% cap on itemizations apply to small business owners' income? So that's a little bit different of an issue. Business owners are not, with business owners, you're going to deduct business expenses against business income. The question here is, does that 35% cap on itemization affect a business owner? The 35% cap is on itemized deductions on your personal return. As a business owner, you would do your deductions for business expenses against your business income and then transfer your net income over to your personal return. So in essence, it's a different methodology. So in that sense, again, I'd go talk to your accountant, but you can deduct the business expenses against business income before worrying about your personal return. So it's a slightly different issue. I got a very specific question about property in Florida, and I know who you are. So if you want to give me a call, we can talk about that. That's a different, I don't want to get that detailed because it is unique to you. So this is an interesting question, and I don't know the answer. The question is on 529s and Trump accounts, can we set up either of them for grandchildren residing outside the US? I actually don't know the answer to that. I would have to look it up, and that's a different issue. So whether it's me or someone you work with, happy to look that up if you want to get contact. All right. And then the last question is, again, for a small business owner, if you don't have enough income in a year, can you still deduct business expenses? That's a tax question that I'm going to leave to your accountant because there are certain rules around this that I want them to answer. It's very specific to businesses. So I'm going to let that one slide. Sorry, but that's my prerogative. So with that, I'm going to close today out early. I wanted this to be something simple and easy to understand, so I hope I made it that way. To that point, we do have a quarterly economic update coming in October. What I point out too, in case you haven't seen it, on October 1st, we actually have an economist from BlackRock doing a presentation for all clients. I will be moderating that with him. So if you have not seen that, please reach out, but by all means, join us on October 1st for that as well. And with that, I hand the rest of the day over to you. For those of you that need other questions, feel free to get a hold of me and have a great day. Bye bye.